Hello and welcome back to Investing for Generations, your channel for high quality stock research for long-term value investor. And today I want to continue my series of 5 undervalued businesses, and today number 4. I will analyze the total stock, and you also find the other 3 videos, of course, on my channel. Here up you find the link to the playlist of these undervalued businesses. So feel free to find that out. There are some very interesting businesses. But today I want to talk about the company, a home builder company. And the name of this company is a Lennar. Is traded at $88 right now with a market capitalization of $26 billion, a PE ratio of 11, and a forward dividend yield of 1.13%. Lennar was founded in Miami in 1954, and then after that they acquired a lot of other companies, and as a result they became the nation's largest home builder in terms of consolidated revenues, with fiscal year 2020 consolidated revenues of $22.5 billion. And when we look at the stock price of Lennar over the last 25 years, and we see this is a lot of up and down and up and down. But then lately, since 2010 to now, with the low interest rates and the boom in the real estate market, it just go up and up and up, and it's over 6 times your money in the last 10 years. And the question is it a good time to buy into this company, and to what price? What is intrinsic value? I will also calculate that in this video. And therefore, as always, I go to Macro Trends, a very good, high recommended website where you find almost every financial numbers of almost every business. And we start with the revenue of Lennar, and the revenue just grew over the last 5 years from 9.47 billion to now 22.48 billion. This is quite a bit. This is a high growing rate over the last 5 years. And also when we look at the earnings per share, then we see this grew a lot over the last 5 years from $3.39 to lately $7.85. Also high growing business. When we look at the margins, then we see that they work on very stable margins around 10% all the time. The return on investment right now is 10%. Normally it's somewhere between 6 and 10%. That's okay. That's fine. It's not super good. And when we look at the return on equity, then we see it's almost always between 10 and 14%, which is also okay. It's good. A very nice picture, and this is maybe the most important, is the free cash flow. And the free cash flow over the last 5 years just grew from $1.04 per share to lately $13.31. Very high growth also in the free cash flow. And then last but not least, also look at the balance sheet. And when we look at the balance sheet, we see that they decreased their long-term debt over the last years immensely to now 5.96 billion, and this compared to the shareholder equity of 18 billion brings us to a debt equity ratio of 0.33. That is very solid. I really like that. And then also when we look in the future, then it's projected that there will be a big deficit of homes for sale and rent, and so it seems like there's still room to grow, a lot of room to grow. And also the demographic trends play in the hands of Lennar. So overall we have again a very high quality business with high cash flows, a very solid balance sheet, a growing market, overall almost perfect. But of course, then there are also risks, and the highest risk for the home building sector is that the mortgage rates, the interest rates could rise. We saw this lately. If we are maybe on a new cycle with rising rates, then this could have a big impact, of course, in the home building sector. And this is a big risk. You have to have this in mind. We have now a decade with very, very low interest rates, with historical low interest rates, and at some point, of course, this will turn around. Maybe we are at the start of the new cycle. Who knows? Nobody really knows, but it's one thing you have to keep in mind. With all the positive we have here in the sector and with the company, we also have to have in mind the risks. And then, of course, after we found out that we have a good business here, a really good company, then of course the question is, what is intrinsic value? Because price is what you pay, value is what you get. And so the price is also very important. And therefore I go again to the Excel sheet of Sven Carlin, one of the best YouTuber in the finance sector here. And I put a link with a free download in the description of this video. And to calculate the intrinsic value, we need, first of all, we have to know what we put in. I have two metrics I put in here, the earnings per share or the free cash flow. The free cash flow normally is a little bit more precise, but just to have another margin of safety, to be more conservative, I just put in the lower one, the EPS or the free cash flow. And in this case with Lennar, the EPS is lower with $7.85. And the next we have to know is the growth rate. And the growth rate, the estimated growth rate for Lennar is between 8 and 10%. And so I put here the lower end with 8%, and in the years 6 to 10, 6%. This should be conservative with a terminal multiplier of 12, which is a historical PE ratio of Lennar. And all of that discounted by my expected return of 12%. 12% is my expected return when I invest in the stock market, almost always. And when we calculate all of that together, then we come to an intrinsic value of $119. And then of course we have a best case and worst case scenario. And in the best case scenario, of course, the growth rate's a little bit higher, the terminal multiplier a little bit higher, and also then of course the intrinsic value. And in the worst case scenario, the growth rate is a way lower, the terminal multiplier is way lower, and then of course the intrinsic value is also lower. And then when you think about that and say, okay, that for the normal case scenario the probability is maybe 60%, and for the worst and best case scenario each 20, then you come to an intrinsic value of $116. And of course the intrinsic value of around $116 is way higher than the $88 which is Lennar traded right now. This is more than 20% up, and this is of course a big margin of safety. And so it's really interesting, at least when we maybe see a little bit lower prices, maybe prices around 80, 75 or something, I think then I will take a first position, because the company overall have a very good market position and is really, really solid, very solid company for the long term. So that's it for today. If you like this video, please give me a big thumbs up, subscribe to the channel and ring the notification bell to never miss another video, and especially the number 5 video of my 5 undervalued businesses. And if you're new to my channel, you should also know every weekend you get the full insight to my real money portfolio. So see you then, take care, bye bye.